What if I told you that you could invest in real estate and earn dividends without the hassle of being a landlord? REITs are your ticket to this dream. The FTSE Nareit All Equity REITs Index has averaged an annual return of around 11.8% since 1972. Today, we're revealing the top 3 REITs you should consider for your portfolio, so let's dive in. So what exactly are REITs? Well, the acronym stands for Real Estate Investment Trusts. Essentially, REITs are the companies that own, operate, or finance income-producing real estate across a range of property sectors. These can include everything from shopping malls and office buildings to apartments, warehouses, and even data centers. REITs were created by Congress in 1960 to make it possible for individual investors to earn a share of the income produced through commercial real estate ownership without actually having to buy, manage, or finance any property themselves. This innovation was designed to democratize real estate investing, opening it up to everyday investors, not just the wealthy. REITs come in several different forms, each focusing on different aspects of real estate investment. Equity REITs. These are the most common type and own and operate income-generating real estate. For example, Equity Residential (EQR) specializes in apartment buildings, while Simon Property Group (SPG) focuses on shopping malls. Mortgage REITs, MREITs. These REITs don't own properties directly. Instead, they provide financing for income-producing real estate by purchasing or originating mortgages and mortgage-backed securities. Annaly Capital Management, NLY, is a well-known example. Hybrid REITs. These REITs combine the investment strategies of both equity REITs and mortgage REITs, allowing them to diversify their revenue streams. REITs generate income primarily through leasing space and collecting rents on the properties they own. This rental income is the main source of revenue for most REITs. For instance, a REIT that owns office buildings will lease space to businesses, and the rents paid by these tenants form the REIT's revenue stream. One of the key features of REITs is their obligation to distribute at least 90% of their taxable income to shareholders as dividends. This requirement ensures that REITs are passing on most of their earnings to investors. For example, Prologis, PLD. In 2022, Prologis distributed $1.5 billion in dividends to its shareholders, reflecting its strong income from leasing logistics properties. Realty-owned, known as the Monthly Dividend Company, Realty Income has a history of consistent dividend payments. In 2022, it paid out over $1.2 billion in dividends. In addition to income from dividends, REIT investors can also benefit from capital appreciation. As the value of the properties owned by the REIT increases, the market price of the REIT's shares can also rise. This capital appreciation adds another layer of potential returns for investors. Historically, REITs have offered attractive returns. For instance, the FTSE Nareit All Equity REITs Index has delivered an average annual return of around 11.8% from 1972 to 2019. This means that with a $10K investment, you could potentially see significant growth over time, especially if you reinvest your dividends. Now, if you had invested $10,000 in the FTSE Nareit All Equity REITs Index in 1972, your investment would have grown to over $1.5 million by 2019, assuming you reinvested all dividends. That's the power of compound interest at work. But what about more recent performance? Well, over the past 20 years, REITs have still performed well, with the FTSE Nareit All Equity REITs Index averaging an annual return of 10.4%. Even in the past 10 years, despite market volatility, REITs have managed to deliver solid returns. So how much can you make with REITs? Well, the answer depends on the specific REIT and market conditions, but historically, REITs have provided strong returns and steady income. By carefully selecting high-quality REITs like those we will explore next and reinvesting dividends, you can potentially achieve significant growth and income over time. Next, we'll also reveal our top 3 REIT recommendations backed by real-life data and expert insights. Ready to boost your investment portfolio? Well, let's get into it. Now, before we go on, drop a comment on what you've learned so far down below. Okay, let's kick off our top 3 REIT recommendations with Public Storage, ticker symbol PSA. Public Storage is a giant in the self-storage industry and has been a reliable performer for decades. Founded in 1972, Public Storage has grown to become the largest self-storage company in the United States. Headquartered in Glendale, California, Public Storage operates over 3,000 self-storage facilities across 40 states, offering approximately 218 million net rentable square feet. They also have a 35% equity interest in SureGuard Self-Storage, which operates 275 facilities in 7 Western European countries. As of June 2024, Public Storage has a market cap of around $51.1 billion. The company boasts a dividend yield of approximately 4.1%, making it an attractive option for income-focused investors. Looking at the past 5 years, Public Storage has shown solid stock performance. For instance, in 2023, the stock price ranged from $233.18 to $312.25. Despite market fluctuations, PSA has managed to maintain a steady upward trajectory, reflecting its strong business model and market position. So why should you consider investing in Public Storage? Well, the self-storage industry has been growing steadily, driven by increasing demand for storage space. This demand is fueled by various factors, including urbanization, smaller living spaces, and the need for temporary storage solutions during life transitions. Public Storage has capitalized on this trend with impressive historical performance. For example, in 2023, the company reported a revenue of $3.8 billion with high occupancy rates and consistent dividend payouts. Even during economic downturns, Public Storage has demonstrated resilience. During the 2020 pandemic, the company maintained high occupancy rates and continued to pay dividends. An example of Public Storage's performance during economic downturns is its response to the 2008 financial crisis. While many companies struggled, Public Storage managed to maintain its dividend payments and even saw an increase in demand for storage space as people downsized and needed extra storage. Analysts are optimistic about its future growth prospects, citing the company's strategic acquisitions and expansions. For instance, Public Storage recently acquired Easy Storage, adding 48 properties to its portfolio and expanding its presence in key markets. With a stable dividend yield of around 4.1%, your $10,000 investment in PSA 5 years ago would have grown to approximately $15,864.22. Not including the additional gains from reinvested dividends. Next up, we have Extra Space Storage, ticker symbol EXR. Founded in 1977 and headquartered in Salt Lake City, Utah, Extra Space Storage is a major player in the self-storage industry. As of December 31st, 2023, the company owned and/or operated 3,714 self-storage stores across 42 states and Washington, D.C., making it the largest operator of self-storage properties in the United States. Extra Space Storage offers approximately 283 million square feet of rentable space, serving a wide range of customers, including individuals, businesses, and even RV and boat owners. The company operates under several brands, including Extra Space, Life Storage, and Storage Express. As of June 2024, Extra Space Storage has a market cap of around $33.7 billion. The company boasts a dividend yield of approximately 4.07%. In 2023, the stock price ranged from $101.19 to $164.99, despite market fluctuations. The self-storage industry has been growing steadily, driven by increasing demand for storage space. This demand is fueled by various factors, including urbanization and smaller living spaces. Extra Space Storage has capitalized on this trend with impressive historical performance. For example, in 2023, the company reported a revenue of $1.9 billion with high occupancy rates and consistent dividend payouts. Last but certainly not least, let's talk about Realty Income, ticker symbol O. Known as the monthly dividend company, Realty Income is a standout in the REIT world. Founded in 1969, Realty Income has built a reputation for providing dependable monthly dividends, making it a favorite among income-focused investors. As of June 2024, Realty Income has a market cap of approximately $46.7 billion. The company boasts a forward dividend yield of around 5.88%, making it an attractive option for income-focused investors. Realty Income has a track record of consistent revenue growth and high occupancy rates. As of March 31st, 2024, the company's portfolio occupancy rate was an impressive 98.6%. This high occupancy rate is a testament to the quality of Realty Income's properties and the strength of its tenant relationships. Realty Income also recently completed a merger with Spirit Realty Capital, adding over 1,000 properties to its portfolio and expanding its presence in key markets, making it earn a top spot for the investment of your $10K. Now that we've covered our top 3 REIT recommendations, let's do a side-by-side comparison of Public Storage, PSA, Extra Space Storage, EXR, and Realty Income, O. We'll look at key metrics like dividend yield, historical performance, and growth potential to help you make an informed decision. So first up, let's talk about dividend yield. This is a crucial metric for income-focused investors as it indicates how much income you can expect from your investment. Public Storage, PSA, 4.1%. Extra Space Storage, EXR, 4.07%. Realty Income, O, 5.88%. As you can see, Realty Income offers the highest dividend yield among the 3, making it an attractive option for those seeking steady income. Next, let's look at historical performance. This gives us an idea of how these REITs have performed over the years. Public Storage, PSA. Over the past 5 years, PSA has delivered an average annual return of around 8.44%. Extra Space Storage, EXR. EXR has outperformed PSA with an average annual return of approximately 12.10% over the same period. Realty Income, O. Realty Income has shown a solid performance with an average annual rate of about 9.56%. Extra Space Storage has been the top performer in terms of historical returns, but all 3 REITs have shown strong and consistent growth. In summary, each of these REITs offers unique benefits. PSA, strong market position and stable dividends. EXR, impressive historical performance and growth potential. And O, highest dividend yield and diversified portfolio. Consider your investment goals and risk tolerance when choosing the best REIT for your portfolio. Many REITs, including PSA, EXR, and O, offer dividend reinvestment plans, or DRIPs. These plans allow you to automatically reinvest your dividends to purchase additional shares of the REIT, often without paying any sales fees. This means your dividends start earning dividends, creating a snowball effect that can lead to substantial growth over time. So let's break down with an example. Suppose you invest $10,000 in Realty Income, O, with a dividend yield of 5.88%. If you reinvest your dividends, your investment will grow faster due to the power of compounding. Over 20 years, assuming an average annual return of 9.56%, your investment could grow to over $60,000. Reinvesting dividends is a powerful strategy that can help you maximize your returns and build wealth over time. It's a simple yet effective way to take advantage of the high yields offered by REITs. And there you have it. By carefully selecting high-quality REITs and reinvesting your dividends, you can achieve significant growth and income over time. Did you know dividends can be so powerful that you can live off them and even retire early? Check out our episode on how to live off dividends quickly, $2,900 a month, to see how to maximize the power of dividends.